George of the jungle, strong as he can be.
So oftentimes when someone's applying for a loan, their loan officer will respond to their question about, well, how much can I qualify for? The typical response is, well, we need to run it through the Automated Underwriting System. So we're going to discuss what that is today in thecreditjungle.com. This is George Anderson, and thanks for joining. The Automated Underwriting System is an acronym for, or AUS is the acronym for Automated Underwriting System, but there's not really a one thing that's AUS. There's two primary versions of that, and in the secondary mortgage market, most loans are delivered to either Fannie Mae or to Freddie Mac. There are some that are delivered to Ginnie Mae as well, but not exclusively government loans. To kind of get into a little bit separate issue that we can discuss some other time. But Fannie Mae uses a system called Desktop Underwriter, and Freddie Mac uses a system called Loan Prospector. And both of these systems, DU and LP are the acronyms, are used for conventional FHA and VA loans, but they're not used for USDA loans, and those are rural housing loans. But you know, in Utah we have, I think, 20 of the 26 counties are all eligible for USDA loans. There are a handful that are not. Most of them are concentrated around the Wasatch Front, but even in St. George, you have a lot of areas down there that are still eligible for USDA loans. But USDA uses a system called GUS, or Government Underwriting System. But anyway, there are some benefits to being able to get a loan approved through an AUS system. Those benefits would be that on a good loan, that the appraisal might get waived. You might only need 1 year of tax returns. We don't have to verify a rental history if somebody's a first-time buyer and like maybe they've been living with family or they've been paying rent somewhere, and we don't have to verify that verification of rent. And then for really clean loans, there is also an option that is called one-day certainty, where literally the verifications of deposit, employment, the credit report, and everything else can be done almost instantaneously. And that is something that you've probably seen a lot of commercials for and heard about on the radio. It's called Push Button Get Mortgage. And it's a wonderful feature, but there's a fairly small percentage of people that will actually fit into that, where they can get a one-day certainty approval and just, go out and shop after that. Those would typically be people that are purchasing a home or doing a rate and term refinance, not trying to get cash out. Their equity position is strong, maybe 20% or greater. Credit scores are high, 740 and above. Debt ratios are low, and they have a lot more money in the bank than what they need to buy the house. So in other words, there's excess money or reserves. So most of the loans that people are getting these days, they actually require somebody who's a mortgage professional to help them kind of navigate through that a little bit. But what are the factors that automated underwriting looks at to determine whether or not it's going to approve it or not? So these are common sense things, and we've talked about it before, but automated underwriting looks at credit scores. Now, you can get automated underwriting approval on an FHA loan with scores down quite low. I mean, you can get it down to 620, and there's even some things where you might get it below that. It's unusual. Conventional, about 620 is your floor, but the higher the credit score, there's some more flexibility with some things that you can do. Like you can push the debt to income ratios a little bit more. You can buy the house with a little bit less money down. You can get a little bit lower mortgage insurance. Those are some of the benefits on that. But it's going to look at credit scores. It's going to look at what is the down payment percentage. It's going to look at your debt to income ratios. On a conventional loan, if your debt ratio is over 45%, and what do we mean by the debt ratio? Well, it's your house payment plus your other debts divided by your income. So if your house payment is going to be $2,000 a month, you have a $500 car payment, and you make $5,000 a month, well, your house payment, $2,000 divided by $5,000, is going to be 40%. Did I get that right? Yeah. And then car payment of $500 a month, well, $2,500 divided by $5,000 is 50%. Conventional loan, about 49.9 is where that's going to tap out on there, but that's how that ratio is calculated. But then it also looks at the type of transaction you're doing. An investment property is going to have some little bit stricter requirements. You're going to have more reserves in the bank, and that's one of the other requirements that go into an automated underwriting approval. So when your lender is telling you they need to run it through automated underwriting, they're doing that because they want to see, can I push those debt ratios up to the limit with the minimum down with the credit scores that I have? Because if they can do that, and if the information that you provided or which has been verified is correct, then you can rest assured that you've got a loan that's going to go through. Now, therein lies the art of being a lender, is to determine, is the income that you put into the system, because it's an automated system, it's a computer program. If you put in bad data or you put in data that's unverifiable, the system is going to say, well, yeah, that's a good loan, we'll take it. But if the income documentation doesn't support what you put in, or if there's some other factors in there that aren't measuring up to what the computer says that it's looking for, well, the underwriter is going to ask for you to rerun that with some different numbers, and it may not come back with the same approval that you had to start with. So anyway, hope that explains the process. And it's something that, my processor does it. Used to be a day when I used to do it myself, but that is a delegated function to my processor, and actually both processors. And it's just kind of the world we live in. It's been around now for over 20 years, and the mortgage market relies upon those findings to determine your eligibility for a loan. So thanks for coming into thecreditjungle.com today. This is George Anderson, and I would love to talk with you about your situation, and I hope to see you soon. Thanks.